Hello, I'm Tim Jenkinson from Oxford University, and I'm here with Jon Moulton today from Better Capital. And I wanted to start with a frivolous question, Jon, but I was wondering if you liked my jacket.
No, I had actually been admiring it.
Yes, because it is one of yours, you see.
Yes, in fairness, it's not one of our more recent ones, and,
No.
you really could do with a new one, and possibly something to get rid of the dandruff, but anyway.
But as you may have known, Jon, one of his most recent acquisitions is the Jaeger chain. And can you just tell us a bit? Is that a standard Better Capital sort of deal?
Yeah, I was losing a lot of money, had very dubious finances, and a colourful history. That's a standard sort of Better Capital deal. It was in trouble largely because it didn't have enough money to buy any stock, and it's difficult to run a profitable retailer without stock.
Right. Okay. And Better Capital are they a distressed player or a turnaround, or what do you call yourselves?
We call ourselves turnaround because we only buy things that have got brackets around the operating line, losses.
Right.
So the fact that it's just got too much debt may or may not be the case.
Right. And so is your perception of the distressed market, which are there seems to be a lot of money in the distressed market at the moment, and yet a lot of the funds seem to be saying that they're not doing any deals, whereas you seem to be doing a lot of deals. Are these two very different markets?
They are two different markets. Distressed is driven, amongst other things, by the sheer volume of debt. We're not. We're mostly driven by a mixture of management inadequacy, morons and crooks. Those are the key generators of deals for us.
Yeah. If you were an investor in distress, would you be worried at the fact that they can't seem to deploy their capital?
I would expect lower returns. There's too much capital relative to the amount of assets that's available for them to invest in. So the pressure's been taken on the price.
Changing the subject a bit, does it feel these days in the private equity world like we're back in 2007? We see debt levels getting up to the same sort of level. We're back with Cov Light. Have we really got such short memories?
Yes, we have got very short memories, and we're in a very different economic world. Let's see if the outcome's the same this time.
And are you confident that these funds will continue to be able to service these sorts of levels of debt?
Not at all. If you take the average of the last 20 years interest rates instead of the current ones, deals at 6 times EBITDA and debt will probably get in trouble.
Right. Okay. And on the whole macro environment, I know you're a bit of you remain worried. I think you think we're not out of the crisis. Do you want to just give us your reasons why you're not as gung-ho as some politicians?
Well, we're standing here today with this minor little problem of the US government not being able to pay its staff. We've got at least a sporting chance they'll default on their debts in a couple of weeks. Traditionally, this is a time you'd call deeply troubled. If you look at Europe, it's a horror show: low growth, massive unemployment, youth unemployment, low participation in the workforce, lousy demographics, too much debt and big deficits. Other than that, there's every reason to be cheerful.
And if you were there with a vote in the US, would you be debt ceiling or sky's the limit?
I would actually be debt ceiling. I come from a turnaround world. I like to see things solved, not kicked down the road. They're kicking it down the road again. They have to deal with it sooner or later. And there are, regrettably, only 3 things you can do with debt. Service it, default on it, or inflate it to hell.
And what's your bet?
They'll inflate it to hell. But that'll be very painful when it happens.
Right. Well, on that cheery note from SuperReturn in Abu Dhabi, back to the office.
Thank you.